Welcome back. In today's session, we're diving deeper into the world of accounting and business finance. Before we jump into new concepts, let's take a moment to review what we have already learned. Accounting is a process, and by process, we mean the language we use to record financial transactions. Recording transactions, the process of creating the memorandum of journal entries, classification, how we create ledgers to organize financial data, summarizing, preparing trial balances, profit and loss statements, and the balance sheet, analyzing, comparing financial results with previous periods to assess performance, reporting, communicating the financial information to users of the accounting records. Okay, now, what we will learn in today's class. What are financial transactions? What is revenue? What are expenses? What are assets? What is liability? Characteristics of accounting. So what exactly are financial transactions? A financial transaction is the exchange of goods or services for money or any other form of payment. What do we mean by the exchange of goods and services? Let's dive deeper into this. Let's also look at some examples to better understand how goods and services are exchanged for money. Okay, students, now let's understand financial transactions with the example of our shopkeeper, Mr. Rajkumar. Watch carefully as I will ask you questions about it. Mr. Rajkumar is selling pasta to Ansh for $10. Is it an exchange of goods or services? If you said exchange of goods, you're right. The shopkeeper is exchanging goods for money. Here are a few more examples to understand exchange of goods.
Hello, I want vegetables, tomato, cucumber, and spinach.
Of course, ma'am. Here are all the vegetables. Please help yourself.
This is all I want to buy. How much for everything?
It will be $15, ma'am.
No, it's too much. I can give you $10, okay?
Okay, ma'am. How about $12? I cannot go lower than that.
Okay, here you go. But listen, if these vegetables aren't fresh, I will never buy again from you.
Alright students, what have you learned from this example of the lady buying vegetables from the shopkeeper? Let's test your understanding with a few questions.
Yes, we're ready. Let's do it.
Let's do it.
Perfect. So, here's first question. Is this an exchange of goods or services?
Sir, it's an exchange of goods. The lady is getting vegetables in return for money. And remember, goods are physical items that we can touch or see, like tomatoes, chips, and milk, etc.
Excellent, Ansh. Well explained. Now, for question 2, I'm expecting an answer from Nishan. What did the lady give in return for the vegetables?
Sir, she gave money for the vegetables she bought.
Correct, Ansh. The lady paid money in exchange for the vegetables. Now, it's your turn, Bushra, for the third question. How is this example called a financial transaction?
Sir, this is called a financial transaction because money is involved. The lady paid money and in return, she got vegetables. Simple exchange of money for goods.
Exactly, Bushra. A financial transaction is any exchange where money is involved in return for goods or services. But here's a tricky question for all of you. What if the lady doesn't have money right now and promises to pay later? Will that still be considered a financial transaction?
We're not sure, sir.
So, even though the lady hasn't paid yet, this is still a financial transaction. Why? Because the shopkeeper is giving the vegetables first and the lady promises to pay later. There is an agreement and in the end, the shopkeeper will get the money. So it's still a financial transaction.
So, sir, it means we can estimate the value of goods and are sure to get paid in the future. So it's a financial transaction.
Yes, you are right, Bushra. Some other common examples of exchanging goods are a clothing shop selling a shirt in exchange for payment, a bookstore selling a books in return for money. Now let's talk about the exchange of services in more detail to clear up the concept. First, what is a service?
So I think a service is Something that someone does for another person, but it's not really a physical product. I'm not completely sure.
Well, Bushra, you're right. Very good. A service is an action or work done for someone. It doesn't result in a tangible product, but it helps the person receiving the service in some way. Now, let's talk about the exchange of services. Let's understand with example of our consultant, Mr. Abhinav.
Hello, Mr. Abhinav. I need help with my business. My sales are down and I need your advice.
Sure, I can help.
Thank you, Mr. Abhinav. Your advice was very helpful. How much do I owe you?
The fee for this consultation is $200.
Here you go. Thank you.
Okay, students, have you watched it carefully? Any questions in your mind?
Sir, I'm confused. She came empty handed and after just talking, she gave money and left with empty hands. Why?
Ansh, perfect question. Any student wants to answer this?
Sir, she paid for the service. Even though it's not a physical product, the advice Mr. Abhinav gave her will help her business grow. That advice has value, and that's what she's paying for.
Excellent, Nishant. That's a perfect explanation of the example. Now, Ansh, is it clear to you?
Yes, I got it. It simply means that if a person is offering a service, they can get money in return. And it's called exchange of service.
Perfect, Ansh. Now, can anyone tell me 3 examples of daily services we get and pay for?
Sir, one common example is we get our hair cut and give money to the hairdresser.
Sir, we go to the doctor and get his service and give them money in return.
So yes, when the teacher gets paid for teaching students, that's also exchange of service.
Perfect, students. I hope you've understood this topic. Now, tell me, what if we get a service but don't have money and promise to pay later? Would it still be considered a financial transaction?
Yes, sir. We've learned this in the exchange of goods. It would still be a financial transaction because in the end, Mr. Rajkumar will get the money.
Perfect. You guys are really smart. We've seen that every transaction highlighted here involves money. Whether it's paid immediately or is payable, receivable at a later stage, the estimated value of the transaction is always clear. For instance, we can easily calculate how much we need to pay or how much we will receive. Therefore, we can conclude that any transaction involving money is a financial transaction. All monetary transactions, whether involving the exchange of goods or services, are considered financial transactions. What is revenue? Revenue is the total amount of money a business collects from its normal operations, typically through the sale of goods or services. It represents the money generated before any expenses are deducted. Let's understand this better. In our example video, we will see what revenue is and how it is recorded in the books of accounts.
That'll be $10 for the pastor.
How much money did he collect from this sale?
$10, sir.
The milk is $5.
How much did he collect?
$5, sir.
That'll be $3 for the bread.
How much money did he collect from this sale?
$3, sir.
Right! So let's put it all together. The total revenue Mr. Rajkumar collected that day is the sum of all these individual sales. Who can calculate the total revenue?
$10 plus $5 plus $3 equals $18, sir.
Exactly, Nishant. Mr. Rajkumar's total revenue for the day is $18. So, class, this is how revenue works. It's the total amount of money collected from selling goods or services. In Mr. Rajkumar's case, his total revenue for that day was $18 from the 3 customers who bought pasta, milk, and bread.
So revenue is the money Mr. Rajkumar receives from selling products, right?
Absolutely. Revenue is the total amount of money generated from sales. Keep in mind that revenue does not account for costs or expenses, it's simply the money coming in. This is how revenue will be calculated. But wait, where do we record revenue? Where is it shown in the books of accounts? Revenue is recorded in the profit and loss statement. Let's take a look at the example. On the profit and loss sheet, you will see revenue listed at the top. Right next to it, we've written $18. This is the revenue generated from the sales at 7-Eleven snacks. Revenue is the total receipts of the business from its operations, that is, business operations. So, in the books of accounts, the total revenue is shown in the profit and loss statement under the revenue section. This is how we record revenue in the books of accounts. What is expenses? Expenses are the costs a business incurs to operate and generate revenue. These expenses are essential for maintaining daily operations. But before we dive into understanding expenses, let me ask you a few questions. Can a shopkeeper run a business without paying for electricity? Can a store stay open without paying rent for the space? Can employees work without receiving the salary or wages? These are just a few examples of the everyday expenses that businesses must pay in order to function. Let's break it down a bit further. Salary paid to employees, rent for the shop or office, wages for workers. These expenses are essential for keeping the business running smoothly.
Guys, guess what? My dad helped me understand the topic of expenses even better.
Really, what did he tell you? Share with us.
He explained that he has to pay expenses to run the business smoothly, including the shop rent, electricity bills, and the salary of the shop manager. After covering these expenses, the remaining money is his profit.
And you have expenses too, you know.
What expenses do I have?
Mr. Anch, the pasta you eat every day is your expense.
Oh guys, I love pasta and I can definitely handle my pasta expenses.
Now, what is assets? Assets in a business are resources that provide future economic benefits, either by generating revenue or supporting operations. In simple words, assets are things a business owns that help it make money or keep things running smoothly. Let's look at how assets are listed in a balance sheet, where the business lists everything valuable it owns. Let's go through some key assets one by one. First, land and building. This is where the business operates, and it's a valuable asset because it helps the business function and earn money.
Beta, guess what? I just bought this shop. I am so excited.
Wait, you bought it? But I thought you were renting it.
Yep, no more rent for me. Now this shop is officially my asset.
Asset? What does that even mean? Is it like a treasure?
Kind of. An asset is something you own that helps you make money or grow in value. This shop is mine now, and instead of paying rent every month, I own it. So it's helping me save money. Plus, if I decide to sell it later, it might be worth more.
So, like if you bought some shop furniture and sold it later for more money, it would be an asset too? Exactly. Shop furniture will be our asset as we use it to improve our business.
Wow, Dad! Give me a pizza treat for buying this store and turning it into an asset for the future.
Oh, as always, Nishant. Well, after buying this shop, I'm left with no money. We'll have pizza later, alright?
Oh, come on, Dad. You can't be serious.
Alright, let's go. But remember, that pizza is an expense, not an asset.
Wow, I love you, Dad. Let's go.
Next, furniture. This includes things like tables, chairs, and shelves, which are necessary for the business to work smoothly. Now, stock. This is the products the business sells, like snacks or drinks. Stock is important because it's what the business sells to make money. Next, we have cash in bank. This is the money the business has in its bank accounts, ready to be used for paying bills, investing, or running operations. And here are some more examples of assets in a business. Vehicle, cars or trucks used for delivering goods or running the business. Business goodwill. The reputation and trust the business has built, which adds value over time. Debtors. Customers who owe money to the business for goods or services bought on credit. Prepaid bills. Payments made in advance for services or products the business will use in the future. Now let's talk about liabilities. Liabilities are the financial obligations or debts that a business owes. These obligations come from past transactions or events, and the business needs to settle them in the future, either by paying money, goods, or services. In simple words, liabilities are the money or things a business owes to others. Just like we did with assets, let's go through some important liabilities listed in the balance sheet. First, sundry creditors are amounts the business owes to suppliers for goods or services bought on credit. These are short-term debts to be paid soon.
I need stock to run my shop properly. Can you give me stock on credit? I don't have money right now.
Okay, Mr. Rajkumar. We trust you because of your good reputation. You can pay later. This will be your liability.
Sure, I understand. I know I have to pay this money to you later. It's my liability. Thank you.
Next, the bank loan is money borrowed from a bank that the business needs to pay back over time with interest.
Good morning. I'm looking to expand my business and need a loan. Can you help me with that?
Of course, Mr. Rajkumar, we can offer you a loan. But remember, this loan will be your liability. You'll have to repay it over time.
I understand. I'm confident I'll be able to repay it. I'll use the loan to grow my business and increase my revenue.
That sounds good. We'll process your application, and once approved, the loan will be yours. Just remember, it's a liability you'll need to manage carefully to ensure timely repayment.
Next, outstanding expenses. Outstanding expenses are bills the business owes for work done but not yet paid for, like salaries due in December for November. Finally, capital. Capital is the money the owner invests in the business to help it grow. For example, Mr. Rajkumar is the owner of this business. He has invested his own money into the business to help it expand and earn profits. This money is called capital. Just like when you put your money in a bank account to earn interest, Mr. Rajkumar's investment helps the business grow. In the balance sheet, this capital shows the amount the business owes back to Mr. Rajkumar as his investment. Now let's learn about the characteristics of accounting. Identifying transactions. Accounting tracks transactions and events that can be measured in monetary terms. The first characteristic of accounting is identifying transactions. This means that accounting focuses on recognizing and recording activities or events that involve money. Only events that can be measured in monetary terms are considered transactions. Now, let's test your understanding with some examples. I'll show you some scenarios, and you have to decide if they are transactions or not. Bushra, what do you think? Is it a transaction or not?
So, this is a transaction because the shopkeeper is receiving money in exchange for the goods he sold.
Correct, Bushra. That's a transaction because it involves the exchange of money. Now, Ansh, here's your turn. Is this a transaction? The shopkeeper is yelling at an employee. What do you think?
I don't think this is a transaction because there is no exchange of money involved.
Exactly, Ansh. You're right. Yelling at an employee doesn't involve any money being exchanged, so it isn't a transaction. Now, Nishant, here's a tricky one for you. A lady has received groceries but doesn't have money right now. She promises to pay later. Is this a transaction or not?
Sir, I think it is a transaction because she promised to pay later and the shopkeeper will eventually receive the money.
Good, Nishant. You're correct. It is a transaction. Alright, students. Now let's move on to the next characteristic of accounting, which is measuring transactions. Can anyone tell me what measuring transactions means?
Does it mean figuring out how much money is involved in a transaction?
Sir, I think measuring transactions means we calculate the exact value of every transaction in terms of money.
Yeah, I think the same. So every time something happens in the business, we need to know how much money was exchanged, right? And also the exact amount.
Exactly, students. You all are right. Measuring transactions means we need to know how much money is involved in each business activity. In accounting, every time money is exchanged or promised to be paid, we measure it in a standard unit, like a country's currency, dollars, rupees, or other currencies. To understand this better, let's look at an example where we can measure the exact amount of money in a transaction.
That'll be $10 for the pasta. The milk is $5. That'll be $3 for the bread.
We looked at 3 examples where we can measure the exact amount of money in a transaction. The shopkeeper receives $10 for selling pasta. The shopkeeper receives $5 for selling milk. The shopkeeper sells bread for $3 with the customer promising to pay later. All 3 transactions are measurable in dollars, as we can clearly determine the amount of money involved, whether it's paid immediately or promised for later. Now that we've understood measuring transactions, what do you think we do next?
Sir, we record all measurable transactions in the memorandum of journal.
Perfect, Nishant. That's absolutely right. We record all measurable transactions in the memorandum of journal. This helps keep an accurate record of every business activity that involves money. Now, let's move on to the 4th characteristic of accounting: classifying. After we record all measurable transactions in the memorandum of journal, we need to classify these transactions into related categories. For example, we use different registers like cash register for cash transactions, debtor register for amounts owed by customers, creditor register for amounts owed to suppliers, expense register for all expense-related transactions, and bank register for all bank-related transactions. So, my question for you is, why do we need to classify transactions into different registers?
Sir, after classification, it will be easy for us to compare transactions and understand all the business activities more clearly.
Right, Bushra. Classifying transactions helps organize records, making it easier to manage and report financial information. It saves time when we need to find specific details about cash, debtors, expenses, or bank transactions. Now, let's move on to the next characteristic of accounting: analyzing and interpreting. Once we've classified all transactions, the next step is to analyze and interpret the data. This means looking at the information in the registers to understand what it tells us about the business. By analyzing the data, we can create important financial statements such as the trial balance, profit and loss statement, and the balance sheet. These statements help us summarize the business's performance and financial position. The final characteristic of accounting is communicating. Communicating means sharing financial reports with stakeholders like managers, investors, and banks. This helps them make informed decisions about the business. So, we've now covered all the characteristics of accounting. Does anyone want to review what we've learned so far?
First, we identify the transactions that involve money. Then we measure them in terms of the exact amount. After that, we record them in the memorandum of journal. Next, we classify the transactions into the correct registers. We then analyze and interpret the data to create reports. Finally, we communicate the financial information with stakeholders like managers, investors, and banks to help them make informed decisions.
Thank you for watching. Don't forget to like, share, and subscribe for more updates. For more information or to purchase the full course, feel free to reach out to us.